Then there was the Fed. It did nothing, leaving rates unchanged, but it said a lot, sort of. The economy is, quote, solid, it said. Job gains are strong, but inflation, pressed by plunging oil, is very weak. So the Fed said it will remain patient about raising interest rates. And with that, money zipped out of stocks and into bonds. Here's how the major equity averages looked at the close. The Dow off 195 points, the Nasdaq down 43, and the S&P lower by 27. U.S. Treasury prices, by contrast, soared as yields moved lower. The rate on the 10-year bond closed at a fresh 20-month low. On the 30-year, it dipped to 2.3%, a record low. Oil prices fell to a nearly 6-year low after the government reported record-high stockpiles of fuel, 2 times as much as expected, raising fresh worries about a global glut amid declining demand. Domestic crude off nearly 4%, Brent down $1 a barrel. Hampton Pearson now with more on today's big Fed decision.
Janet Yellen and fellow monetary policymakers wrapped up the first Fed meeting of the year by making clear no rate hike is imminent. Since the last meeting in December, the overall economy has been expanding at a solid pace, and thanks to falling energy prices plus a strong dollar, inflation has fallen even further below the Fed's 2% target. Reason enough, the FOMC judges, it can be patient in beginning to normalize the stance of monetary policy. Leading economists and Fed watchers are looking towards the mid-June meeting as the first real test of the Fed's patience.
They are going to look at inflation as transitory low, and a couple years from now, inflation will be higher. So it isn't going to be zero rates. The question is, when do we have a small rate hike, and what will the path be? Because the economy is going to get very hot, and it even is getting a little hot now.
While the Fed did not mention the slowing global economy, it did say it will take international developments into account in determining when to start raising interest rates. That triggered concerns in the bond markets, with yields on U.S. Treasuries going lower.
Keep in mind that while the ECB had made this pretty big move in terms of quantitative easing, and that's going to put more upward pressure on the dollar, which is going to hurt exports, certainly affect the economy.
It's not so much the point about what the Fed is saying they're going to do. It's that they're saying for the first time we're worried about international markets, so money floods into the U.S.
The first Fed meeting of the new year finds Janet Yellen and fellow policymakers unified and, yes, patient when it comes to what's next for monetary policy. For Nightly Business Report, I'm Hampton Pearson at the Federal Reserve.